Budgeting is one of the most important management accounting techniques used to translate organizational objectives into detailed financial and operational plans. A budget is a quantified plan, expressed in monetary or physical terms, prepared and approved before a defined period of time, showing the planned income, expenditure, assets, liabilities, and resource utilization required to achieve organizational objectives. Budgeting provides a systematic framework for planning, coordination, communication, control, and performance evaluation, making it an essential component of strategic and operational management. In modern organizations, budgeting not only allocates scarce resources efficiently, but also supports decision-making, accountability, and continuous performance improvement. Why organizations use budgeting? Organizations prepare budgets for several interrelated managerial purposes. The primary objective is planning, whereby management establishes future goals and determines the resources necessary to achieve them. Budgets translate strategic objectives into operational activities by forecasting sales, production requirements, labor needs, material purchases, cash flows, and capital investment. Budgeting also facilitates coordination by ensuring that the activities of different departments are aligned toward common organizational objectives. Sales forecasts determine production schedules, which in turn influence purchasing, labor planning, inventory management, and financing requirements. The budgeting process therefore integrates departmental activities into a coherent organizational plan. Another important purpose is communication. Budgets communicate management expectations, priorities, and performance targets throughout the organization, ensuring that managers understand their responsibilities and the resources available to them. This improves organizational alignment and accountability. Budgets further support motivation by establishing measurable performance targets against which managers and employees can evaluate their achievements. Realistic and participative budgeting systems encourage employee commitment and responsibility while promoting continuous improvement. Perhaps the most significant function of budgeting is control. Actual performance can be compared with budgeted expectations through variance analysis, enabling management to identify deviations, investigate underlying causes, and implement corrective actions. Budgetary control, therefore, provides an essential feedback mechanism supporting operational efficiency and organizational effectiveness. Finally, budgeting supports decision-making by providing quantitative information for evaluating alternative courses of action, assessing financial feasibility, managing liquidity, and allocating scarce resources efficiently across competing activities. The planning and control cycle. Budgeting operates within a continuous planning and control cycle, linking strategic objectives with operational performance through a process of planning, implementation, monitoring, evaluation, and feedback. The cycle begins with the establishment of organizational objectives, which reflect long-term strategic goals determined by senior management. These objectives are translated into detailed operational plans and budgets that specify expected revenues, costs, production volumes, staffing levels, and investment activities for the forthcoming budget period. Once budgets have been approved, operational activities are implemented according to the planned resource allocations. Throughout the budget period, actual performance data are collected and compared against budgeted expectations through budgetary control reports. Significant variances are analyzed to identify operational inefficiencies, unexpected environmental changes, or forecasting inaccuracies. Management then implements corrective actions where necessary, revises operational activities, or updates future plans to reflect changing circumstances. Information obtained through performance evaluation feeds back into the next planning cycle, making budgeting a continuous process of organizational learning and performance improvement rather than a once-a-year exercise. Administrative procedures in the budgeting process. Effective budgeting requires well-defined administrative procedures to ensure consistency, coordination, and accountability throughout the organization. Responsibility for budgeting is typically assigned to a budget committee, comprising senior managers responsible for coordinating budget preparation, resolving conflicts between departments, approving assumptions, and monitoring implementation. The budgeting process is often directed by a budget manual, which specifies organizational policies, budgeting procedures, reporting formats, responsibilities, timetables, and documentation requirements. The manual ensures that all departments follow consistent budgeting standards and methodologies. A designated budget officer or management accountant frequently coordinates the collection of departmental budgets, consolidates financial information, reviews assumptions for consistency, and prepares the master budget for senior management approval. Clear communication channels, standard reporting procedures, and regular budget meetings facilitate cooperation between departments and improve the quality of budget preparation. Stages in the budgeting process. The budgeting process consists of several sequential stages designed to produce realistic and coordinated financial plans. The process begins with collecting relevant information, including historical accounting data, market research, economic forecasts, production capacity information, inflation expectations, labor availability, competitor analysis, and government economic statistics. Reliable internal and external data provide the foundation for accurate budget preparation. The next stage involves forecasting future business conditions, particularly expected sales demand, market growth, exchange rates, inflation, and economic activity. Forecasting is critical because future sales volumes determine production requirements, purchasing plans, staffing levels, capital expenditure, and financing needs. Forecasting, therefore, provides the quantitative assumptions upon which budgets are constructed. Departments then prepare draft budgets based on forecast information and organizational objectives. Individual budgets may include sales budgets, production budgets, materials budgets, labor budgets, overhead budgets, cash budgets, and capital expenditure budgets. These draft budgets are negotiated and reviewed by management to ensure feasibility, resource availability, and consistency across departments. Following negotiation, budgets are agreed and approved, forming the organization's formal financial plan for the forthcoming period. Approved budgets establish performance targets and resource allocations against which actual results will subsequently be measured. Finally, budgets are implemented, monitored, and revised where necessary through continuous budgetary control procedures. Regular comparison of actual performance with budgeted expectations allows management to identify significant variances and adapt organizational plans to changing business conditions. Overall, budgeting represents a comprehensive management system that integrates planning, forecasting, coordination, communication, motivation, and control. By transforming strategic objectives into measurable operational targets, budgeting enables organizations to allocate resources efficiently, monitor performance systematically, and support informed managerial decision-making in an increasingly dynamic business environment.